Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Undis Holdings.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
We are diving into a company that's put itself in a really unique spot. It's right at the meeting point of three massive growth themes.
Three huge ones.
Exactly. You've got autonomous drone systems, industrial wireless networking, and maybe the most critical one right now, counter-drone tech.
Counter-UAS, yeah. And that positioning, well, it's starting to show up in the financials in a way that's, frankly, pretty spectacular.
Okay, so that Q3 report was the big catalyst.
It set the entire narrative. The results were just stunning.
So give us the headline numbers. What are we looking at?
All right, so revenue hit $10.1 million for the quarter. Now, that might not sound huge on its own.
But it's all about the context.
It's all about the context. That number is a 580% increase year over year.
580%.
It's almost a six-fold increase in just 12 months.
A six-fold revenue jump isn't just growth. That's parabolic. And it wasn't just a fluke against an easy comparison from last year.
Not at all. Quarter over quarter was up 60%.
Yeah?
And that sequential jump is the real proof. It shows that demand is just accelerating like crazy right now.
Which explains management's confidence.
Immense confidence. They immediately raised the full year 2025 guidance to at least $36 million, which was way above what anyone was expecting.
Okay, let's unpack this.
Yeah.
Because the ambition here is the really interesting part. They're talking about targeting $110 million for 2026.
Colossal number.
If they hit that, they'd be tripling revenue again. So it really begs the question, can they do this without just hemorrhaging cash?
And that's the trade-off. They're still very much in that early stage growth phase, so yes, they're taking losses to fuel this whole thing. Q3 EPS was negative, somewhere between -3 and -6 cents.
But the trajectory is what matters.
The trajectory is improving dramatically. That's the bet investors are making. You have to look at the margins.
So how much are they improving?
Very significant. Gross profit jumped to $2.6 million in Q3. Right now, the gross margin is sitting at around 26%. But the analysts, they're really bullish.
How bullish?
They're projecting that as the defense segment really scales up, those gross margins could approach 70%.
70%. That's a complete game changer, especially for a company dealing with hardware and defense.
Yeah.
But they have a safety net to chase that, don't they? The balance sheet?
The security blanket. They are sitting on an unprecedented amount of cash.
What are we talking about here?
After their Q3 equity raise, their pro forma cash balance is roughly $840 million.
$840 million. For a company doing $10 million in a quarter, that's an enormous war chest.
It is. It's an all-access pass to the M&A market right now. The financial strength is just staggering. Look at the current ratio.
Liquidity measure.
Right. Liquid assets versus short-term debt. It's above 15.
15. The sector average is what, like under 2?
Exactly. A 15x ratio basically says they have zero near-term liquidity risk, and total debt is tiny, around $11 million.
So if we connect this to the bigger picture.
Yeah. That massive cash hoard gives them incredible flexibility. They can pour money into R&D. They can make these aggressive acquisitions, all without worrying about market swings.
Even though their free cash flow is still negative.
It's negative because they're investing so heavily. They're burning cash to grow, but they have $840 million worth of fuel for that fire.
Which brings us right to their strategy. This isn't just about organic growth, is it?
Not at all. They are deliberately acting as a consolidator. They're trying to roll up key technologies in the counter-drone and AI defense space.
And the biggest move they've made so far, the one that really defines this push, has to be the Sentry acquisition.
Correct. Sentry CS, an Israel-based company, that was a $225 million deal they closed in November.
Their largest today.
By far. And it was a direct shot at gaining scale and penetration in the counter-drone market. This wasn't a small tech buy. This was buying a major piece of the puzzle.
And Sentry's just one piece. There have been other moves, too.
That's right. They bought 51% of Smart Precision Optics, SPO, for their optical tech.
Which is critical for targeting.
Crucial. Then there was a $14 million investment in Safe Pro Group for AI, and another one in PDW Holdings for the drone platforms. They're basically knitting together a whole end-to-end system with their cash.
What's fascinating here is how quickly all this is turning into actual sales. This isn't just on paper.
The contract wins are the proof. The big one was an $8.2 million contract to deploy their Iron drone radar system at a major European airport.
And that's huge because getting into a highly regulated space like a civilian airport is a massive stamp of approval.
It's regulatory validation. It opens the door to hundreds of other critical infrastructure sites all over the world.
What about on the defense side?
The momentum there is huge, too. A big surge in U.S. government and allied orders, and crucially, their systems are combat-proven.
You mean in active conflicts?
Yes, they have public integrations with groups like the Ukrainian Drone Fight Group, plus U.S. border protection contracts. This is technology that's working in the real world right now.
So, massive cash, accelerating revenue, aggressive M&A, real contracts.
Okay, let's look forward. What are the catalysts to watch over the next, say, 3 months?
The immediate one is Q4 earnings. That's expected in February 2026. Everyone's waiting to see if they can keep up this triple-digit growth to prove Q3 wasn't a one-off.
And management has been hinting at more news.
They've been very clear. They've signaled imminent announcements on new defense contracts, both in the U.S. and the EU. Those could be big.
And there's a key regulatory filing coming up because of the Sentry deal, right?
Absolutely. The pro forma financials. That document will give the market its first real consolidated look at the combined company. The revenue run rate, the margins. It's a huge moment for validation. Okay, that's the confirmed stuff. Now for the fun stuff. What's the market chatter? The speculation.
The rumor mill is very active. Given the Sentry deal, there's a lot of talk about more Israeli tech acquisitions.
That seems to be a hotbed for this kind of tech.
It really is. And on the deployment side, people expect to see new contracts for critical U.S. infrastructure, like more airports or maybe power plants.
And what's the biggest rumor? The one that would really move the stock?
The big one is the potential for a strategic partnership with a major defense prime, a Lockheed Martin or a Raytheon.
Wow. Okay, that would be a total game changer.
It would validate everything overnight, and it would give them access to global distribution channels that would take years to build on their own. That's the big speculative prize to watch for.
Let's shift to the technicals and risks. This is a high-octane stock, as you said.
Oh, absolutely. It has a high beta around 2.36.
Which, for our listeners, just means it's volatile. Moves a lot more than the broader market, up and down.
Exactly. Big risk, but also potential for outsized rewards. Technically, the trend is very strong. It's trading well above its 50-day and 200-day moving averages.
And the trading range.
You're looking at strong support around $6.25, with the upside being tested up around that $11.70 to $12 mark.
Here's where it gets really interesting, though. The ownership.
The institutional ownership.
Right.
It surged 97% last quarter.
97%. So this isn't just retail investors chasing a trend. These are the big funds, the long-term players, building major positions.
And the analysts agree with them. The street is net bullish. Multiple firms have raised their price targets. Some are calling for 50% upside into that $12, $13 range.
But every growth story has risks. Let's get into the bear case. What are the two biggest headwinds here?
The first one is the classic for any company growing this fast. Execution risk. They're still losing money, and the challenge of scaling revenue 6 times over while trying to integrate a huge acquisition like Sentry. It's immense.
If they stumble on that integration, the story falls apart.
It gets hit hard. The second risk is dilution. That $840 million didn't appear out of nowhere.
Right. It came from issuing a ton of new shares.
A staggering amount. The share count went up 352% in 2025. That waters down the value for existing shareholders. And you have to mention the recent insider selling from director Ron Stern.
How much did he sell?
About $6.7 million worth. Now, it could be for personal reasons, but insider selling always makes the market a bit nervous.
So you have this tension, massive dilution, but also this massive cash pile. How much does that cash really mitigate the risk?
It's the ultimate mitigating factor. It's an insolvency shield. It gives them a runway of potentially years to keep funding R&D and absorb losses while they scale up. That cash gives them breathing room that their competitors just don't have.
It seems like the whole investment thesis comes down to betting on management's ability to execute.
Flawlessly. It's a bet on their ability to integrate these complex acquisitions.
So for someone looking at this, what's the right time frame to think about?
It's interesting because it's attractive on 2 very different timelines. Short term, you have a ton of catalysts coming up, earnings, contract news, that create trading opportunities. But it's also a compelling long-term hold if you believe in the multi-year growth of defense tech and infrastructure security.
So what does this all mean? At the end of the day, the test for Ondas Holdings is whether they can turn these aggressive acquisitions, especially Sentry, into actual margin expansion.
Exactly. Can they get to that 70% gross margin figure? Can they hit the $110 million revenue target for 2026?
That's what will prove the strategy was worth the price. The success of the integration is everything. That's the point you need to keep mulling over.
If you enjoyed this analysis and want more in-depth looks at high-growth market opportunities, make sure you hit that subscribe button.
Welcome to Smart Wealth with Joshua.